Welcome back, everyone, to this explainer session. Today, we're establishing a rigorous, hyper-focused look at AQA topic 3.1.3, target market. Look, as dedicated business students, you already know that simply having a fantastic product just isn't enough anymore. If you don't know exactly who you're selling it to, well, you're essentially just shouting into the void. So this session is designed to really sharpen your theoretical knowledge and elevate your exam technique. We'll be moving step by step through the course specification requirements, locking down that pedagogical bedrock, and then applying it to some really high-level evaluation scenarios. Okay, let's dive into this. Our agenda today covers 4 core areas: the purpose of market segmentation, niche versus mass markets, adapting the marketing mix, and finally, market entry decisions. Section 1. Purpose of market segmentation. So, market segmentation is the process of taking a massive, broad target market and slicing it up into distinct subsets of consumers who share similar needs, behaviors, or characteristics. You can think of it like a giant puzzle, and it is the absolute foundation of any modern marketing strategy. For your exams, you've got to be totally comfortable distinguishing between the 4 main types. We've got demographic segmentation, grouping by things like age or income. Geographic, based on location, because obviously you wouldn't heavily market surfboards in Sheffield, right? Then there's psychographic, which gets into the really interesting stuff like values, attitudes, and lifestyles. And finally, behavioural, looking closely at usage rates and brand loyalty. Grouping consumers like this is absolutely crucial. It literally stops businesses from blowing their marketing budgets on the wrong people and gives them a razor-sharp competitive edge. And this brilliantly illustrates exactly what we're talking about in the real world. Let's look at the Far More Cycles case study. They're an independent bicycle retailer set up as a worker cooperative. Notice their core values: democracy, honesty, and social responsibility. Because they operate on these very specific principles, they attract a highly specific, psychographically aligned customer base. But take a close look at their marketing data. Their online sales make up only 15% of their total, which is significantly lower than the industry average. And look at their digital cost per click, a massive £7.80 compared to just £3.20 paid by the big national chains. This clearly shows us that because of their cooperative values and those steep marketing costs, they absolutely have to nail down a highly specific target audience if they want to survive against mass market rivals who are just coasting on massive economies of scale. Right, now it's time for you to actually apply this. Please pause the video now and complete task 1. Remember, to secure those AO3 marks, you need to build a logical, multi-step chain of reasoning. Don't just tell me that they use psychographic segmentation. Explain the so what. Why does targeting specific values and behaviors allow an independent retailer to offset their higher costs? How does it build the kind of bulletproof customer loyalty they need to survive against cheaper national chains? Section 2. Niche versus mass markets. Now, what's really interesting about this slide is the direct contrast in financial dynamics between these 2 strategic approaches. In a mass market, think of your big bicycle chains like Argos or Halfords. The whole goal is targeting broad consumer needs. The distinct advantage they have is lower unit costs, completely driven by economies of scale, which leads to incredibly high sales volumes. The catch? It is a fiercely competitive space. On the flip side, niche markets target highly specialized needs. Because the audience is much smaller, naturally the sales volume is lower. But, and this is a massive point for your exams, because the product is so specialized, these businesses can almost always charge a premium price. That means much higher operating profit margins. Plus, going niche often requires a much lower initial investment, which really minimizes the upfront financial risk. So, how exactly does a niche strategy actually lead to that higher operating profit margin? Let's model a perfect AO3 chain of reasoning together. Step 1. By targeting a niche, a business builds a strong, clearly distinguishable brand that is tailored to that exact specific group. Step 2. This highly tailored approach develops intense customer loyalty and trust. They feel seen. Step 3. Because of this intense loyalty, the product's price elasticity of demand becomes more inelastic. That means the value drops below 1. Consumers literally become less sensitive to your price tags. And finally, step 4. This inelasticity enables the business to push prices higher without suffering a proportional drop in sales volume. Ultimately, that increases the operating profit margin. This flow right here is exactly how you want to structure your analytical paragraphs. Section 3. Adapting the marketing mix. Changing market conditions and your chosen target segment dictate absolutely every decision you make regarding the marketing mix. Take your product. If you're going after a mass market, you're probably leaning heavily on extension strategies just to squeeze every bit of life out of proven goods. But for a niche, that audience demands continuous new product development. Now think about price. Entering a cutthroat mass market, you're probably looking at penetration pricing just to grab a sliver of market share. But for a premium niche, you want price skimming. That leverages the inelastic demand we literally just talked about. Place is the same story. It could be wide, multi-channel distribution using big retailers, or it could be highly controlled, direct e-commerce to fiercely protect your brand's exclusive image. And for promotion, mass markets use broad, shotgun-style advertising, whereas modern niche marketing relies incredibly heavily on data analytics to achieve hyper-personalization. Time to put this into practice again. Please pause the video now and complete task 2. For your AO2 application here, I really want you to tightly align your chosen adaptations with the premium nature of your specific niche context. Make absolutely sure your pricing method and your promotional channels logically fit the high-end audience you've selected. Make it realistic. Section 4. Market Entry Decisions. Let's move to and see how this builds into complex strategic decision-making. When a business is sitting down deciding whether to enter a new target market, they aren't just looking at the marketing fluff. They are staring hard at finance and risk. They have to evaluate the initial investment required against the true financial risk. They have to weigh a much smaller market size against the promise of a higher operating profit margin. They also need to pull in sophisticated concepts like income elasticity of demand. Think about it. If average incomes fall during a recession, is this specific target market going to just stop buying? And crucially, they must look at the hard quantitative data. Does the expected rate of return on the investment actually exceed the cost of borrowing? If a firm is targeting a 10% return, but bank loan rates are sitting at 8%, that margin for error is incredibly slim. Top-tier students will always bring these harsh financial and economic realities into their marketing evaluations. This brings us to your final climactic challenge. Pause the video now and complete task 3. This task demands a coherent, well-argued judgment. You have got to weigh both sides, the massive potential for higher margins and a better reputation in a niche, completely weighed against the painful loss of economies of scale and the massive financial risks involved in pivoting an entire mass-market business model. Give me a definitive conclusion and make sure it's firmly supported by the evidence we've covered today.
So what does this all mean? The biggest takeaway from this explainer is that selecting a target market is never, ever a static set-it-and-forget-it decision. It is the beating heart of your entire business strategy. If your market evolved and your strategy doesn't, you're facing strategic drift. But if you can align your segmentation, your marketing mix, and your financial entry decisions perfectly, that is a strategic masterstroke. Ask yourself, does your target market accurately reflect your actual competitive advantage? Keep that provocative question in mind as you head into your exams. Thank you so much for joining this explainer, and keep up the focused revision. You've got this.